Hello everyone, my name is Moji. You're watching a Bitcoin bubble news channel? To stay high enough is starting to have an effect on the private sector a little more each quarter, especially on the weaker side, so customers should be aware of that. Didn't own assets, didn't lock in mortgage rates, and maybe even had credit card debt with variable rates and other things like that. The business real estate market is imploding slowly but surely. The job market is starting to soften because of these kinds of effects. The rate of jobless goes up from 3.4% to 4.1%. Continuing claims are going up, which is a sign of a pretty quick shift that we can check. Also, it seems like people have been spending a lot of money in stores lately. Lyn Alden talks about the rise of fiscal power and how it will affect markets in the videos we have today. She also talks about Bitcoin as a backup asset, how the election will change the types of assets that will do well in the next 3 to 6 months, and other things. People in the United States have more fixed-rate debt than people in other parts of the world. Many people in other parts of the world, on the other hand, have more variable-rate debt, which stays set for a shorter time and then changes more often. On top of that, our companies took out more long-term debt with fixed rates than the usual company in other markets. In turn, this meant that when the Fed raised rates, it didn't have a big effect on most homes or businesses. Smaller parts of the market, like short-term bank loans for small businesses or industrial real estate, which has been a total mess. In general, business bonds with a junk rating and a shorter term get refinanced more often. However, those markets tend to be smaller than those for the other main types of loans. In a strange twist, the average length of time that the US federal government lasts is not that long. About 6 years. Still, even that is a bit of a shock because T-bills have terms ranging from very short to 30 years. It's likely that a lot of the 6 years that make up the average are spent in the first 2 years. As a result, they raised interest rates and then kept them pretty high. This caused a lot of debt to default, which means bigger deficits and higher interest costs. In a strange way, are good for the economy because they balance out some of the price increases we've seen in the private sector. In comparison to the rest of the world, the US was pretty resistant to rate hikes. Now, in 2022, I thought they would probably run into problems sooner than they did. But it wasn't until early 2023 that I realized this difference in length was having a bigger and faster effect than I thought. Because of this, I had to change my focus to the idea of fiscal dominance and kind of say it again. And that's still pretty much the case right now. I also talked about this in my most recent newsletter. If the Fed slightly lowers interest rates, it might not have a big effect on the economy. Is it worth it to refinance your bills at these higher rates? Not many people have them locked in. In general, the last 40 years of us economic history have seen lower lows and lower highs for interest rates, including rates on long-term loans like mortgages. This was the first time that both short-term and long-term interest rates hit a higher high point. There's a good chance that the low will go up because of interest rates, which makes it harder to refinance. It's not likely that many homeowners will be ready to jump in and refinance. The number of people who actually took out mortgages at these fairly high rates has definitely gone down because those rates are so high. The same goes for business loans. This will have an effect on some parts of the economy that are more sensitive to interest rates, but I think the market is over-indexing as a whole. How important somewhat small rate cuts or hikes are, or when they're going to happen. But I think a much more important thing to pay attention to is fiscal policy, which is not run by the Fed but by Congress and the government. In the US, spot Ethereum exchange-traded funds ADS dropped a total of $13.3 million on their second trading day. This was mostly because the Grayscale's Ethereum Trust lost a lot of money. As of the second day of trading, money came into 7 of the 8 new spot Ethereum ETFs, with $74.5 million and $29.6 million, respectively. The Fidelity Ethereum Fund F and the Bitwise Ethereum ATF BIT got the most money. Third place went to BlackRock's Shares Ethereum Trust. On July 2nd and 3, the most money came into Ether. But on July 24th, however, it only got $17.4 million from buyers. People who recently bought the Grayscale Ethereum Trust ETH sold a lot, taking $326.50 million out of its investment pool. This hurt the new ETF. Ethereum could be bought by institutional buyers, but all of their money was locked up for 6 months. People who had Ethereum could sell it more easily after July 22nd, when ETH changed to a spot Ethereum fund. $811 million has left ETH in the 2 days since the change. In other words, people who had put money into it have now sold just over 9% of it. Things that have recently done well with the Ethereum ETF aren't unusual. On 6 out of 10 of the first trading days for Bitcoin ETFs, money left the funds. the dark Bitcoin Trust ETF was blamed by many for the money leaving the fund. Bitcoin only dropped 2.6%, but Ethereum fell much more sharply. This fits with Wilk's assumption that Ethereum's price might be very affected by money coming in after the ETF grayscales go live. On its first day of trading as a spot Ethereum ETF, ETH lost $4,844 million. However, strong flows into the other 8 products brought the total net gains to close to $16.6 million. It seems like high enough is having a bigger effect on the private sector every quarter, especially on the weaker side. For people who don't own anything, didn't lock in their mortgage rates, or may even have credit card debt with variable rates and other issues like that, the business real estate market is slowly collapsing. The job market is starting to soften because of these kinds of effects. The rate of jobless goes up from 3.4% to 4.1%. Continuing claims are going up, which is a sign of a pretty quick shift that we can check. And, retail sales have been pretty strong lately, but they're still not really strong in the big picture. It just beat predictions that weren't very good. So I think we're seeing a bit of a rotation. Basically, during and right after the lockdowns, when people couldn't move and weren't really going anywhere, they bought a lot of homes, consumer goods, and even homes and changes they made to their own homes. When more doors opened, people switched between travel, restaurants, and other similar jobs. There's that kind of pent-up desire. It's all right. We already knew what our customer durables were. We bought everything we needed when we were at home. We're now going to, travel, eat out, and do other things. So we saw that cycle where the customer really took the lead. It's more like we've been in a mild industrial recession for the past year and a half. Also, commercial real estate is very bad. In other words, there are parts of the economy that are weak and parts that are strong. Some of those interest costs have also made the customer side stronger. The people with more money, for example, have a lot of mortgages with set rates. They have places to buy money. That's why they got more money every time the Fed raised rates. When it comes to Social Security, they sometimes get money. Also, all of their investments are doing pretty well. The stock market is up. Because of this, there has been a lot of spending by consumers, especially those with better incomes. That seems to be getting a little less strong based on the numbers. It's still good, but it's getting weaker. In the meantime, industrial activity seems to have reached a plateau. People don't have to think about whether there is a recession or not. Like, are we going to go into one? It's not often that fiscal and monetary policy are so different from one another. Right now they are. In order to keep industry at over 5% and shrink the Fed's balance sheet, we're running deficits of about 6% of GDP. There are 2 strategies that are very different from each other. Because of this, areas that are on the right or wrong side of either short-term debt or fiscal deficits will be affected in very different ways. Even so, I think we are seeing the first signs of a change. The consumer may be getting a little weaker on the edges, as shown by the slightly weaker payroll statistics. BTC dropped below $65,000 for the first time in 6 days. Most likely, this is because of a change in the market's mood and the time of year,